Welcome back to another explainer. So let's just dive right into this massive, kind of mind-bending paradox that's currently gripping the modern equity market. Here is the brutal truth we're looking at today. Meta just announced that they're going to spend more on AI this year than the entire market cap of 80% of the companies in the S&P 500, which is insane, right? But instead of cheering them on, the market actually punished it. Today we're going to figure out why. We'll explore why more spending is currently acting as a massive liability, not an asset, and why Meta's projected capital expenditure, their Capex, is a glaring warning sign for retail investors. We're pulling back the curtain on this liquidity drain to see how massive Capex can literally kill stock valuations, even when profits look like they're going up.
Okay, here's our roadmap for today. First, we're hitting the earnings beat paradox. Second, the anatomy of the Capex trap. Third, the scale of capital. Fourth, free cash flow compression. Fifth, the great liquidity drain. And finally, number 6, the compute for labor swap. Let's get into it. So, let's start with a question that absolutely baffled the retail market back in early 2026. Meta announced this massive first-quarter revenue surge of 33%. They blew consensus estimates completely out of the water. On paper, it looked like a total home run. That's the kind of report where you'd fully expect the stock to dap up like 10% at the opening bell, right? With everyone rushing in to grab that momentum. But nope. The market's immediate response was a sharp 6% drop in the share price. Billions of dollars in market value just wiped out in a flash. So, why on earth would a stock crash after completely crushing its earnings or expectations? Well, to get that, we have to look past the flashy headlines and see what the institutional money, the big players, are actually looking at.
Which brings us to Section 1, the earnings beat paradox. It's really a story of illusion versus reality.
You see, there's this really stark contrast right now in how amateurs and professionals are reading the exact same data. The retail investor logs in, sees a diluted earnings per share of $10.44, which is a massive 62% jump year over year, and thinks, wow, unquestionable win. But the institutional investors, they peel back the layers. They want to see how the sausage is made, and what they noticed was that operational expense growth, sitting at 35%, actually outpaced that stellar 33% revenue growth. So what does that mean? It means those impressive efficiency gains Meta made recently. You remember Mark Zuckerberg's famous year of efficiency? Well, they're already being swallowed whole by the voracious costs of all this new infrastructure. The underlying engine is having to work a lot harder, burning way more fuel just to maintain the same speed. But actually, the illusion goes even deeper than just climbing expenses.
Let's do a little forensic accounting together. That $10.44 reported earnings per share? Turns out it was largely an accounting mirage. If we look at step 2 of our breakdown here, a massive chunk of their reported net income actually came from an $8.03 billion income tax benefit, specifically under U.S. Treasury Notice 2027-7. Now, that is a one-off paper gain. It is not recurring operational cash that the business actually generated from selling ads. So if you subtract that $3.13 per share tax benefit, you arrive at step 3, a clean EPS of $7.31. Suddenly, this isn't some massive earnings beat anymore, right? It's just roughly in line with Wall Street's base expectations, except now it's carrying the really heavy baggage of spiraling, uncontrollable expenses.
All right, moving to Section 2, the anatomy of the Capex trap. This is a huge transformation from Meta.
And this leads us to a crucial concept you really need to internalize, the Capex trap. Basically, this is a phenomenon where massive capital outflows, money spent just to sustain a competitive arms race, erode the intrinsic value of the firm, even as the top-line profits look like they're growing. Think of it kind of like owning a highly profitable bakery in a really cutthroat town. Suddenly, you're forced to buy $1 million state-of-the-art ovens every single year just to stop your rivals from putting you out of business. Now, sure, your overall revenue from selling bread might go up because you're baking a little faster, but the actual cash machine inside the company is being totally dismantled. You aren't actually keeping the money you make. It's all going straight to the oven manufacturers just to fund your survival. And honestly, that is exactly what is happening in the hyper-competitive AI landscape right now.
$145 billion. That is Meta's projected maximum capital expenditure for 2026. Just take a second to let that number truly sink in. We are not talking about the standard cost of doing business here or, a routine server upgrade in an Oregon data center. This is an unprecedented, historic allocation of capital. It fundamentally changes the entire DNA of the company. It essentially marks the definitive death of Meta as that beautiful, asset-light software company that investors originally fell in love with a decade ago. And it marks the birth of Meta, the heavy infrastructure utility.
Let's look at the numbers. Back in 2021, Meta was operating as this incredibly capital-efficient software business. They were spending just 16.3% of their revenue on Capex, which allowed them to generate an unbelievable $39.1 billion in pure free cash flow. That's the actual cash left over that a company can use to pay dividends, buy back stock, or, weather an economic storm. But fast forward to the projection for 2026. Capex is expected to consume up to 64.4% of total revenue, and the resulting free cash flow? It plummets to a terrifying projection of negative $2.0 billion. The cash yield that long-term investors completely rely on for their margin of safety is effectively being starved out just to feed the endless appetite of AI servers.
So why are they forced into this aggressive spending corner? Well, it's this brutal phenomenon known as the Red Queen risk. If you've read Alice in Wonderland, you know the Red Queen. She has to run as fast as she can just to stay in the exact same place. In the AI hardware world, depreciation is just relentless. Compute clusters that you buy for billions of dollars today, in 2024, might be completely technically uncompetitive by 2027 because processing power is leaping exponentially. Meta is basically forced to constantly prepay for next-generation chips before their current generation has even reached peak utilization. They literally cannot stop or they lose the AI race entirely. It's a vicious, unending reinvestment cycle that just traps their capital.
Okay, Section 3, the scale of capital. Let's put this unprecedented spend into perspective.
The brutal truth here is that Meta's planned infrastructure spend for a single year is larger than the entire market cap of 80% of the companies listed in the S&P 500. You look at mid-cap stalwarts like Asasa Abloy or specialized tech players like TechTarget, and they are completely dwarfed by Meta's Capex alone. I mean, Meta is effectively managing a capital budget equivalent to buying a top 100 US company outright in cash every 12 months. And when you're deploying capital at that astronomical scale, your margin for error completely disappears. Every single server rack absolutely must generate a premium return, or the entire financial model just begins to collapse under its own weight.
Moving on to Section 4, free cash flow compression. Let's dig into the technical pathology of this. Now, the absolutely crucial piece of the puzzle here is understanding discounted cash flow, or DCF, particularly given our current interest rate environment. See, in a 1% zero interest rate world, investors absolutely love a massive Capex story. Why? Because a theoretical $1 billion profit 10 years from now is still worth $905 million today. Money is cheap, so investors can be incredibly patient. But we are currently in a 3.75% environment. Suddenly, that exact same $1 billion profit generated in 2036 is only worth $690 million today. The core cost of waiting for that return has skyrocketed, which means those future AI profits lose 23% of their present value right off the bat. When money is no longer free, a $145 billion Capex bill today becomes a massive, heavy liability. It actively destroys the discounted valuation of the stock right before our eyes.
Which brings us to Section 5, the great liquidity drain, and the macro contagion spreading from this.
The thing is, Meta's massive spending spree is happening exactly when the global market has significantly less risk on cash to spare. We are looking at a historic liquidity squeeze in 2026. The U.S. Treasury General Account, which is essentially the federal government's checking account, is pulling $650 billion out of the private sector just to fund operations. On top of that, you've got the highly anticipated SpaceX IPO expected to absorb another $75 billion of investor capital. Then OpenAI and Anthropic are aggressively calling for $240 billion to fund their next models. Add in total hyperscaler Capex across the board, and we are exceeding $615 billion. The ultimate takeaway? Meta is competing for a radically shrinking pool of global liquidity. That makes every single dollar they spend to build these data centers that much more expensive to acquire.
And this leads to a really fascinating market dynamic that we call the NVIDIA paradox. Back in early 2026, NVIDIA reported a record-breaking $68.1 billion in Q1 revenue. But instead of lifting the whole AI sector in a rising tide, it actually triggered a massive sell-off in their hyperscaler customers, including Meta. Now, why would great news for the supplier be terrible news for the buyer? Well, because NVIDIA's massive revenue is concrete, undeniable proof of the massive bill that these companies are paying. Institutional investors have hit what we call peak infrastructure sentiment. Honestly, they no longer care how many cutting-edge chips Meta can buy, they are terrified by the astronomical cost, and they want to know exactly how fast Meta can turn those chips into actual tangible cash flow. All right, final section, number 6, the compute for labor swap. This is their strategic shift.
$2.55 million. That is Meta's staggering 2025 revenue per employee. In this new era of intense capital scarcity, this single metric has become the new institutional lead indicator for predicting stock outperformance. The goal isn't just to blindly grow top-line revenue anymore. The goal is to radically increase the absolute amount of revenue generated by each individual human still remaining at the company. And the method they're using to achieve this extraordinary efficiency is, well, it's incredibly ruthless.
They are achieving this through a cold, calculated compute for labor swap. Meta is cutting roughly 8,000 employees. That's about 10% of its total workforce. But crucially, they are doing this from a position of immense financial strength, not weakness. They are systematically shifting capital away from human payroll, which, let's face it, suffers from wage inflation and physical limits, over to GPUs and silicon infrastructure, which scale infinitely. By augmenting their remaining workforce with AI copilots, they are entirely flattening those middle management layers. They're aggressively pushing manager-to-employee ratios as high as 1:50 in their core AI engineering orgs. It is an aggressive, completely unprecedented attempt at massive margin expansion entirely through silicon replacement.
All this incredible risk and restructuring is being driven by one singular, unwavering vision from CEO Mark Zuckerberg, who said they are focused on building personal superintelligence. But remember the trap we've just uncovered today. This visionary pursuit is literally cannibalizing their traditional, highly profitable social media operations. It is rapidly transitioning Meta from a predictable, high-margin cash cow that value investors absolutely loved into a highly speculative, capital-intensive AI infrastructure bet, where the visibility on actual financial returns is, at least currently, sitting at absolute zero.
So we have to ask ourselves, as Meta navigates this massive Capex trap, aggressively replacing humans with silicon and starving its free cash flow in a high-interest rate environment, what is your margin of safety? The era of retail investors just blindly buying a stock because of a superficial EPS beat on a headline, that is definitively over. In this new landscape, you really must look past the AI hype and demand true, sustainable free cash flow before you allocate your hard-earned capital. Think deeply about that dynamic as you review the AI allocations in your own portfolio. Thank you so much for joining me on this explainer, and keep learning.